What are the three common takeover tactics? The three main tactics are 1. A Bearhug, 2. A tender offer, and 3. A proxy fight. Now let's define each of the three. The Bearhug is usually the first tactic to be adopted to force management to agree to a certain bid. The bidder will contact the management team and express an interest in acquiring the target. It also implies that if management is not receptive to a bid, the bidder will go directly to the shareholders with a tender offer. The Bearhug is usually accompanied by a public announcement of the bidder's intent to make a tender offer. And really what the Bearhug is it attempts to preempt the tender offer. It's a form of resolution in which the hostile bidder approaches the management team and says, hey, either you can negotiate with us now or we're going to go directly to the shareholders through a tender offer. It's your choice. And really, if they go out publicly and really demand and state that they're interested in the company, then the company is in play. And the board of directors has a fiduciary duty to act in the best interest of maximizing shareholder value. And that would mean that negotiating with the hostile bidder is probably the likely course, which again forces management in a difficult position. Now, the tender offer is a public takeover bid where the bidder offers to purchase a company's shares for a certain price. It asks shareholders to tender or offer their shares in acceptance of the bid with the eventual acquisition of these shares at that level if successful. Now, in certain states, the approval percentage is different, but in the state of Delaware and majority of the states in the United States, at least 90% of shareholders need to tender their offer at that level in order for the tender offer to be successful. Now, in a scenario where the majority of shareholders approve the bid and the tender offer is successful, the bidder is able to acquire a majority in the company and squeeze out any remaining minority partners to take control of the company. The big risk from the target company's perspective is that the bid is outside the reach of management. The CEO cannot reject the offer because it is extended directly to shareholders, and legally, the board needs to act in the interest of shareholders and the value of the stock. If there is a sufficient premium, the bid is likely to be accepted and management will lose control of the company in a hostile bidder scenario. And that's really the problem. The CEO can go out publicly and disagree with the offer and say that it's a bad deal, but at the end of the day, legally, they have to act in the best interest of the company and the shareholder value. And so if they are in play and there is a bid and there are no other bids, and again, if the board of directors feels that it's a fair bid, then they will have to go with that bid, regardless of whether they do approve or disapprove of the bidder. Now, the final tactic is through a proxy fight. In this scenario, a single shareholder is a group of hostile shareholders can take control or bring about managerial changes in a company through the use of the proxy mechanism of corporate voting. Although this method is much slower and costly from a legal perspective, in a scenario where the bidder is able to take control of the board and management, submitting a future bid will be more likely to be accepted. And so essentially with the proxy fight, it's the long route to really acquiring a company as a hostile bidder. You integrate yourselves within the board of directors, you build those relationships with the directors, and you really kind of pick and choose. So if you want to elect new directors who are favorable towards you and your own ownership, well, then that means that it will take some time, but eventually you can kind of integrate your people into that company. So when you eventually do bid for the company, majority of the board will be on your side and therefore approve your bid. Now, this is costly. Now, during these proxy votes, there are two main contests that can be pursued. There's the contest, which I referred to, for seats on the board, which provides a hostile bidder with control over the approval of strategic proposals in mergers and acquisitions, or there's a contest about management proposals. It's a less influential way, but it is a way to accept or reject the proposals that management presents to shareholders. So in a scenario where you feel, okay, maybe we shouldn't just fire management, but keep them in place, but really control their actions, well, in that scenario, when management goes to the board of directors on a quarterly basis and recommends a strategy for the company, you and your control over the board and over management are able to influence the actions that are taken by management in order to maximize the company the way you see fit. These are the three common takeover tactics in the M&A process.